In the previous video, we covered what a cash-secured put is. You sell a put option, you collect premium up front, and in return, you agree to potentially buy 100 shares of a stock at a specific price. But once you understand the basics, the next question becomes much more important. How do you actually choose that price? Because in a cash-secured put, the strike price is not just a number on an options chain. It is the price where you may end up owning the stock. That means your strike selection can determine whether the trade feels controlled and intentional, or whether you end up stuck with shares at a price you regret. This video is for educational purposes only. It reflects personal experience and research, and it is not financial advice. Options involve risk of loss, so always do your own research before making any investment decision. The strike price you choose is the single most important decision in the trade, not the premium, not the expiry date, not even the probability number on the platform. The strike price. Because if you pick it wrong, the premium does not save you. That is one of the biggest mistakes new cash-secured put sellers make. They see an attractive premium and think, great, I'm getting paid. But the real question is not, how much can I collect? The real question is, would I be happy to own this stock at this price? That is the anchor. Start with the price at which you would genuinely be willing to buy the stock anyway. Then look at the premium as the reward for waiting, not the other way around. Here is the core insight. Premium is the reward. Strike is the decision. Most beginners approach the options chain backwards. They sort by the highest premium, find the contract that pays the most, and then try to justify the trade afterwards. That is dangerous, because a higher premium usually comes with a higher risk. A higher premium put is often closer to the current stock price, which means there is a higher chance of assignment. In simple terms, you are being paid more because the market thinks there is a greater chance that the stock falls below your strike. So if you chase premium without thinking about the stock price, you may not be creating income. You may just be buying a stock you did not really want at a price you did not really like. Disciplined selection starts differently. First, do I want to own this stock? Second, would I buy it at this price? Third, if I get assigned, is that an acceptable outcome? Only after that do I ask, what premium am I being paid? If the assignment feels like a disaster, it is probably the wrong strike, even if the premium looks attractive. Here is the framework I use. 3 criteria in this exact order. Number 1, own it. Would I genuinely want to own 100 shares of this stock at this price? This is the most important filter. Before I look at premium, before I look at delta, before I look at annualized return, I ask whether I would actually be comfortable owning the stock at that strike. If the answer is no, I move lower on the chain or skip the trade entirely. Number 2, support. Is this price at or near a level of technical support? Support does not guarantee anything. A stock can break through support at any time. But support gives context. It tells me that the market has previously treated this area as a fair or attractive price. For example, if a stock is trading at $100 and has repeatedly bounced around $92, that $92 area may be more interesting than a random strike with no historical relevance. Number 3, return. Does the premium hit my minimum return threshold? For me, the minimum is around 10% annualized return on the capital at risk. If the return is too low, I pass, because even if the strike is safe, the capital still has an opportunity cost. So the full sequence is simple. Would I own it? Is the price supported? Is the return worth the capital? If any one of those 3 fails, I do not force the trade. I either move to a lower strike, wait for better implied volatility, or skip the setup. There is always another opportunity. Once the trade passes the 3 criteria, I use delta as a probability guide. Delta can feel technical, but for cash-secured puts, the practical interpretation is simple. A put with a delta of -0.30 means the market is implying roughly a 30% chance that the option finishes in the money. In plain English, that means roughly a 30% chance that the stock finishes below your strike by expiration. Flip that around, and it means there is roughly a 70% implied probability that the put expires worthless and you keep the full premium. Now, this is not guaranteed. Delta is not a crystal ball. Stocks can move sharply, markets can reprice quickly, and earnings or news events can completely change the picture. But delta is useful because it helps you understand how aggressive your strike selection is. A delta between negative 0.1 and negative 0.2 is more conservative. The premium will be lower, but the probability of assignment is also lower. A delta between negative 0.2 and negative 0.3 is the range I generally like. It balances income and risk. A delta between negative 0.3 and negative 0.4 is more aggressive. You collect more premium, but you are closer to the current stock price and more likely to be assigned. And once you get close to negative 0.5, you are basically near the money. That becomes much more directional and much less conservative. So my usual target zone is negative 0.2 to negative 0.3. Not because it guarantees success, but because it gives me a balanced starting point. Now let's apply this to a simple example. Stock XYZ is trading at $100. We are looking at an expiration 30 days out. The goal is to find the right strike. The options chain shows several choices. At the $98 strike, the premium is $2.40 and the delta is negative 0.46. That premium looks attractive, but the delta tells us this is very aggressive. The strike is close to the current stock price, so assignment risk is high. At the $95 strike, the premium is $1.80 and the delta is negative 0.38. Still attractive income, but still more aggressive than my normal target range. At the $92 strike, the premium is $1.30 and the delta is negative 0.28. This is inside my target zone. The 30-day return is 1.41% and the annualized return is around 17.2%. That passes the return threshold. Now we apply the full framework. Would I own the stock at $92? Let's assume yes. Is $92 near a support level? Let's assume yes. The stock has previously bounced around that area. Does the premium meet the minimum return threshold? Yes, around 17.2% annualized is above the 10% minimum. So in this example, the $92 strike is the pick. Not because it pays the highest premium, it does not. Not because it is the safest strike, it is not. It is the pick because it balances all three criteria: ownership comfort, technical support, and acceptable return. Now compare that with the $88 strike. The delta is negative 0.15, which is safer, but the annualized return is only around 9.7%. That falls below the 10% threshold. So even though it is safer, it may not be worth the capital commitment. That is the discipline. You are not trying to find the highest premium. You are trying to find the best risk-adjusted strike. There are 3 mistakes that cost beginners the most. Mistake number 1, picking the highest premium. More premium almost always means more risk. If a strike pays significantly more, ask why. Usually, it is because the strike is closer to the current stock price, the stock is more volatile, or there is an event coming up. Premium is compensation for risk. It is not free money. Mistake number 2, ignoring earnings dates. This is one of the most important rules in cash-secured puts. Always check whether earnings fall before your option expires. Earnings create binary risk. A stock can gap down sharply overnight, and no delta number can fully protect you from that. Even if the setup looks perfect, I do not want to accidentally hold a cash-secured put through earnings unless I have made that decision intentionally. Mistake number 3, going too far out of the money-chasing safety. This is the opposite problem. Some traders choose a strike so far below the current price that assignment risk is very low, but the premium is almost nothing. That can feel safe, but it may not be efficient. If the return is too thin, your capital is tied up for very little reward. So the trade needs to be balanced. Too close to the stock price, and you are taking too much assignment risk. Too far away, and you are not getting paid enough. The goal is not maximum premium or maximum safety. The goal is disciplined balance. Here is the rule I use every time. Sell puts at prices where you would place a limit buy order anyway, and only if the premium pays you at least 10% annualized for the privilege of waiting. That sentence keeps the strategy clean. If I would not place a limit buy order at that price, I should not sell a put there. If the premium does not pay me enough for the capital at risk, I should not force the trade. And if the trade only looks good because the premium is attractive, I probably have the order backwards. Start with conviction on the stock. Then choose the strike. Then check the premium. Before every cash-secured put trade, I run through this checklist. Would I genuinely own this stock at this price? Is there a meaningful support level nearby? Does the premium hit at least 10% annualized return? Is delta between -0.20 and -0.30? Is there no earnings announcement before expiration? Then I check the key numbers. Target delta range, -0.20 to -0.30. Minimum annualized return, at least 10%. Expiry window, usually 20 to 45 days. And if the trade goes against me, I have a rule in advance. I do not keep rolling forever. My maximum is 2 rolls before I either accept the assignment or reassess the position. The point of the checklist is to remove emotion. You do the thinking before you enter the trade, not after the stock starts moving against you. So let's recap. Premium is the reward. Conviction on the stock is the decision. Use the 3 criteria framework in order, every time. Own it, support, return. Then use delta as a probability guide. For me, the balanced target range is usually -0.20 to -0.30. And remember the one-sentence rule. Sell puts at prices where you would place a limit buy order anyway, and only if the premium pays you enough for waiting. In the next video, we will cover what happens when your cash-secured put goes against you. The stock drops. Your put is in the money. You now have to decide. Close it, roll it, or take the assignment. That is where the strategy becomes real. Subscribe so you do not miss it, and if you have questions, leave them in the comments.